I'm market analyst Michael Filighera of Traders Helping Traders with the Eye of the Storm podcast, helping you make informed trading decisions for the week ahead. Good day, everybody. And my name is Michael Filighera. And today I am here with a friend, a colleague, and someone that I have had a lot of respect for their work over many years. And his name is Ben Letto. And I want to welcome Ben to the podcast. This is the Eye of the Storm podcast for January the 3rd, 2023. Happy New Year.
Thank you, Michael. Yeah, Happy New Year, everybody.
And Happy New Year to everybody else. Actually, they've gotten, this is the third podcast they're going to get in a couple of days here. But we're off to a good start. And what we're going to talk about today is Ben's wonderful new product. But I want to give a little bit of a history on the relationship that I have built with Ben and where it all started. For anybody that might be listening to us today, you may have had exposure, or maybe you even have one of the systems from Indicator Warehouse. And they were and still are, their claim is the birds, so to speak. And so there's the raptor, there's the eagle, the hawk, and the falcon. And what these were programmed algorithms that gave buy and sell signals, and were really quite accurate for many, many years, and still are. And Ben coded them. So Ben was the responsible coder, programmer. Yep. I know for the raptor, and for all of the birds?
Yeah, for all of them. Mm-hmm.
Oh, okay. So the raptor, the falcon, the hawk, and the eagle.
Yep.
And that's Ben's handiwork. So if you have any exposure to Indicator Warehouse, or maybe you even have those products, meet the coder.
Thank you.
And we've all moved on from that, and so has Ben. And so what we're going to talk about today is Ben's latest project, which he has been working and showing me over the past couple of months. I'm very excited about it. It is called Buy One, Sell the Other, or BOSA for short. And it's incredible because it's applicable across many sectors, and within the futures markets, within the Forex markets, within a lot of different things. And Ben has taken his perfect style and now combined it with using it in buy one, sell the other type of a situation. So basically what he's doing is we're setting up trades, or he sets up trades that are going to be considered hedged by your clearing firm. So it allows you to carry these contracts and still keep it within a day trading atmosphere.
Right.
And so because of the volatility in the markets, because of everything that we're dealing with, many of us have become much better day traders than we are position traders. And right now, entering 2023, that's kind of where I'm sticking with my own accounts, is just to maintain a day trading stance. So I am going to turn it over to Ben, who's going to fill in the blanks about his past, his future, and what's going on now. And then hopefully I'm going to flip my screen. And if you're ready to do that, Ben, I can do that now.
Yep, we're ready.
And let me go over to here first off. And I'm going to go here, and I'm going to make you the host. And that's going to take my share away. So now you have the ability to share.
All right. Do I share screen now, right?
Yes.
Gotcha.
You do.
All right, we'll do that. We'll share that. Beautiful. How's that coming over?
And there it is.
All right.
Beautiful.
Well, Michael, thank you for that intro. That's wonderful. Yeah, gosh, I've been working for and with Indicator Warehouse since we go back to 2009. So where did the time go?
Right out the window.
But I admit I've been programming since the early 1980s, so I've been around for a little bit. And right around the turn of the century here in 2000, it captivated my interest when we were getting a lot of data available on the internet. market data. I started programming almost exclusively for day traders. So this kind of launched that whole business, and then been busy, active coding one thing or another for you guys for a long time. So
Yes.
probably I think I've done over 11 or 1200 projects since that time. So it's been
Wow.
busy. Yeah. A lot of fun. Ninja's a great environment too for programmers. So perfect for us. And BOSA, yeah. Well, it's one of my fascinating projects here. So BOSA is a buy one, sell another indicator. And it's really taking a look at two instruments and the idea of spreading one against the other. So you can buy one and sell another. You hedge your risk. You do mute the ability for runaway trades because these two instruments are in correlation to one another. So when one moves up, the other one catches up to it. So the idea is to get a correlated market here. Now there's different variations of this, different ways to manage your risk with this. You could make them very tightly correlated, which is typically if you do a near month versus a far month spread. Let me show you one example of that. Crude oil is a very heavily traded contracts in all months, and that's what you need too. You need a little liquidity, obviously. And this is a very tight chart. Now this is the February crude against the March crude, and it is almost to the penny. It's so tight to one another. It's very hard to trade actually as a spread. There's not a lot of wiggle room. But what's beautiful about this is look at this histogram on the right here, Michael. This is basically a TPO histogram, if you're familiar with the time price opportunity histos. This shows how tightly ranged this spread is, which is exactly what you want. You can actually ignore this long bar. That's just a data issue. But what you're doing is you're trading in a tight range. So you can convert a trending market into a range market, and that's got some advantages. You know, nobody likes to buy at the top and sell at the bottom, right? And when you do that, obviously you're going to take some heat. And this wide-ranging market you could get hurt in. Well, if you spread these two together, you reduce your risk, you turn that big trend market into a ranging market, and that's the advantage here. Let me show you this. The grid here, the spacing is at $200. And that means that these bands here are $200 in equity from one to another. So the gold, it's a yellowish gold color. And the price values here show also a $200 move, you know. So this is from negative 170 is that midline to negative 370 roughly here. So that's $200 in move. So think of it that way. Every time this spread wiggles, it wiggles $100 or $200 one to another. And the idea here is to buy at the low of that range and sell at the high of that range. And this is a very tightly correlated market, so it's kind of boring, but you can still make some money on it. And the advantage is you don't have that huge risk. This isn't going to go flying off based on some news event, right? Because these are tightly correlated.
Right. So if one moves, the other's going to move with it. And
exactly.
Like you said, the back month or the front month catch up to each other.
Right. So you're hedging. It's a beautiful hedge. And, you know, this isn't a new concept. Spread trading has been around probably long before the electronic markets were created. Back when you didn't have those stop loss orders parked somewhere, you hedged your bet, right? You hedged near month against far month. You hedged corn against soybeans. You know, corn and soybeans is used by hog farmers a lot in the industry. So when corn goes up, soybeans will rise too because farmers switch from corn to soybeans for feeding their hogs. So as prices rise, things seem to move together. So there's that correlation. Well, let's go to another market here. I'm just going to go to a little different spread of crude oil. Now I'm looking at the near month against the far month. You can see that in the bottom left. But I'm increasing the contracts traded. So I'm putting a little bit more weight. I'm actually trading two of the February against 3 of the March. So you get variation now. You get a little bit more weight, a little bit more equity weight put on the March contract because you're trading 3 of them. versus 2 on the front month.
So it's sort of like producing an ultra long or an ultra short, depending on which side you're taking, using the futures markets.
Right. That's very well put. Yeah, you're able to tweak in the risk here. Usually the most volatile contracts are the front month, and the back month don't move as much. So now if you put a little bit more equity weight on the back month, which is more stable, and a little bit less equity on the front month, which is more volatile, you're going to now have a little risk edge here. This is a big mover, though. Even still, you can see at a $200 grid spacing, this spread moved up 2, 4, 6, 8, 10, 1,000,
Wow.
$1,400.
Wow. And that's just today.
That's just today. Yeah, this was
That's
at 11
actually just
o'clock.
in the last hour.
Yeah, 11 Eastern is I'm on Eastern time here.
Right. It's like, folks, please take note of this, because this is also the beauty. Everything that Ben is telling us about being correlated, about being basically you're putting on a hedge, which should comfort a lot of people that don't like the risk that that crude can present to us, and getting an understanding about how the front month is going to be more volatile versus the back month, or even just the next month up the scale. Like we're February against March here. And yeah, what a great trade.
Yeah. So, this is a unique product for NinjaTrader. We've never had a spread trading system. So this is very new to the market, very unique, one of a kind, actually. So the ability to kind of reduce your risk, definitely, and you can tailor make a spread to be whatever you like. So we'll go into that a little bit later about what contracts do you pick, what spreads, what instruments do you want to trade against one another. Let's move over, as a matter of fact, to a futures currencies markets now. So this is a spread between the British pound on the long side and the euro on the short side. So these are two markets that are correlated one to another. The economies of Britain versus the economies of the European nations are pretty correlated. Since they're close to one another, they do business quite a bit, even after Brexit. And
yes, exactly.
So you're looking at now these two futures contracts that are correlated. They're not tightly correlated as the calendar spread was in crude. You can see there's a little bit more wiggle. But this grid now is $100 in US dollar equity, so it's a little bit smaller. So $100, $250 move, $200, $300 move up to the top. We're down to a $100 move below the midline. So this also, you can see this oscillates. So the way that I would trade this, and the way that I'm advocating in a lot of my videos on my YouTube channel, which you're free to visit, is we look for when it's overbought, oversold. We look for a big move, and then we look for it to come back together. So when these two instruments diverge from one another, when there's a big move in one and a slowdown in the other, they're going to be the spread is going to show it. This chart will show it far from the yellow line. So it oscillates around the yellow line. And what you want to do is trade back toward the yellow line. That's my approach.
Can just to kind of put this into a little bit different language, when we're trading the equity futures, there are the volume weighted or just the volume profiles, the order profile, and we have what was called the point of control. That's the area where most of the volume is taking place. And if the market moves through or to the upside through the point of control, and normally go up to where they consider the value area high, if it hits the value area high and doesn't break through it, then the concept is that it drifts back down to that point of control.
Right. And
then it could trade below the point of control and again, maybe go to the value area low, but the concept is that it's going to stop and return to that point of control, because I kind of call it that point of comfort.
That's right.
It's where buyers and sellers are agreeable to meet, because that's where the majority of the volume for that period is taking place.
I call it the happy price. Yeah. I like to call it the happy price. That's where everybody's happy to do business.
Yeah. Everybody's okay to come in and do business.
Right.
And as one gains weighting over the other, then we get these extremes like you're showing, and those are the tradable ones.
Now, with spreads, we really don't have a way to relate volume for each of the two instruments to one another. But what we do is instead of the volume weighted profile or the volume profile, is we do look at the profile here on the right, which is a time price opportunity. And what it's just showing is how frequently those price levels are traded at. So it's not a volume per se, but it's a when did price visit those levels, and we do a count. So every time that price hits those levels, we put a count on the histo. And you can see here in this spread, there is a little action, sometimes way here below the midline. Here's the basically the time price opportunity point of control, which is usually right around the yellow line. And sometimes the spread has visited way down here, but otherwise it's very, you can see it's very concentrated. And the blue dots show that volume, value area, which you mentioned. Same concept in the TPOs versus the volume profile. So 70% of the time price is happy between these blue dots, and then the yellow area shows outside of the value area.
So tell us what the right going through the middle is rather thick, but it's a green red some type of indicator.
The average line here.
Yes.
So this is the green and red thick line here is really just a simple moving average. I think I've got it set to 20 or 30, and it's a 20 or 30 period of that spread value, which is these blue histos. But the interesting thing, which is these faint dots you can see below this line. Can you see those red dots there?
Yes.
That also extends past the current price. So this area, let me hide these so I can turn off the bars. This red line right here is below the point of control, or this yellow level. Right. This red line is what I call the spread history. Over the last 15 days, this is the average location. This line here is the average location of the spread. So what it's telling us is that on average, the spread is trading below this yellow line. It's a 15-day historical average of the point of the spread every minute of the day. So the spread seems to like to be on the downside. That's the idea. So right here at 11 o'clock in the morning, the average location of the spread is usually below it by $100. And we were way up here today. So that tells me that we have really reacted contrary to the average position of the spread. So this piques my interest. Also, the fact that this spread is usually, for the entire day, on average, it's below the midline, the yellow line, which I call basically the equivalent line, or equilibrium line is the yellow line. So I'm very interested in selling it when we get overbought here, because the spread is typically downward moving spread, and it's also and you can see that too, just because we've had such a major downside. Typically, the TPO shows us that. So when we get overbought on a spread that likes to go down during the day, that's when we're really interested in selling it, and this would have been a really good trade here.
Yes.
That makes sense?
It does. It makes a lot of sense.
So it's very statistical, and that's one thing people like.
Right. So if someone was going to choose to trade the pound against the euro on this type of a spread, where can they put together this information, or is it just actually working together with you to get the understanding of what the red underneath the point of control, we'll call it, is suggesting that over history, the history of this particular spread is that it trades below value.
Right.
And so our interest gets piqued when we see it trading that far above value. For whatever reason they came in to do it. And because historically we can look at the chart and go like, well, historically it'll get up there, but look how it comes back.
It shows the bias. The bias for this spread is downward, and when it gets upward, it pops out of its bias. We look to short it.
Okay, so just
to
add to the conversation. Now we've decided we're onto that trade, and we can see that red information And now we watch it go all the way up. And only because I've worked with you before, I realized that that kind of magenta is actually a signal.
Right. Yeah. So there's a couple ways we enter this spread, this position. These magenta dots, you can see them above price. They're based on a kind of a modified CCI indicator. So the spread is run through a modified CCI, and we can see, it's a cyclical analysis. We have some really good signals. Here's a great buy signal. I wouldn't be a buyer here again because the bias is down, but when we start seeing red signals coming in, that's when we're looking to short again with the bias being down, and you can see that definitely we move down there. So there's one way to do it. We could trade on these signals. I'd be interested at adding to that, though. You want to add now this red level and these green levels down here. These are you can think of them as volatility bands.
Mm-hmm.
When the spread is the 80% of the prices, let's just put it that way, are below this red line and above this yellow line. So when the spread is above the yellow line, 80% of the time it's limited to this range. 20% of the time it exceeds that range. So very rarely does it go above this range, especially with a down bias. And that's when we're looking to sell right in this zone. This is a perfect zone. We're between this, and there's a little buffer here that I put in to show like a zone area. We just tipped here at this point in time. That could have been a short signal. I would have waited till it matured a little bit, which is exactly what happened here. We got our cycle dots coming in, would have been a great short there. I typically would recommend getting out at the equilibrium level. This one definitely, proceeded below it, but this would have been a good target one. And another signal is, let's see if we can zoom in a little bit here, is this guy is this dot right here is just telling us when the moving average has been red for 3 dots.
Oh, okay.
So yeah, so when this average turned red and there was 3 red dots consecutive, 3 of these red dots on the line. So we get this kind of trend reversal signal or trend direction. We got that back here when 3 green dots printed. We got a blue signal which showed an uptrend was forming. So it's kind of like a way to tell us when the moving average has kind of confirmed a move in one direction or another.
So just taking that trade further, you get a buy signal, which is there by the 3 green dots, and then we got, I'm not sure what that color is. It's going to be kind of like a greenish blue.
It's like a cyan, I believe, the dot here.
Cyan, okay. Now we decide that that's where we're going to put in our entry, but the entry is sitting right on that point of control. So when you get that signal, do you just then go up to what you have at the top with your buy and your sell buttons, and you would then go with the buy button?
Yeah, I mean, if you did want to buy here, I wouldn't recommend it again because the bias is down, but it is definitely a good move. We have some structure putting in here. We're breaking through the tops. We're going higher, so it would have been it could have been a buy signal.
But if we took it as a buy signal, somebody's chosen, now they're going to put this trade on. Walk us through that process because I have 3 basic criteria for winning whatever your trade is.
Right.
Number 1, you want to know and accept what the trigger is. That's where you're going to enter, what your trigger is. And then what is the goal of the trade? So where's your target for the trade?
Yeah, every good trade.
Most important to me is where do you put that stop for when the trade becomes invalidated? Because you've just made some very good points about, well, I don't know if I get in there because the spread tends to work below that value area versus above the value area. So I'd be looking more to take the shorts, but this one's telling me to go ahead and take the long. So I decide, I'm a little bit more of a bull trader. I'm going to take that long.
Yeah.
Where's my stop?
So what I would recommend, the way I do it, I use all price structure and spreads. So you're looking at a place where the spread was rejected. I'd be putting a stop in this area, $100 roughly below the entry area.
Okay.
So you could pull that off. Let me show you one though. that I think is a better definition of a risk for me. And you're right, every good trade has a plan. You got to know when your thesis of going long or short is invalid, and when do you want to hit your target. So yeah, you definitely want to do that. So what I use, and I mentioned this in my videos, is I use something called a homegrown term called an exhaustion triangle. And basically, we're looking at exhausting this spread. We made some new highs. There's a couple of them here. I just drew the latest, but let me draw one here too. We made a new high here. We retraced down to this point, and we started putting in new highs up here, let's say, right? I'm not interested. This is a weak high. This is a strong low, and this is a weak high. These are weak highs as we go up. They're weaker and weaker and weaker. Trends eventually are going to exhaust themselves and return. When this strong low gets broken, that's when I really get interested. So right at that point, that's when I would have looked for shorting. And I would have put my stop right above this weak high. So that's my plan. That's how I trade this this market. And I'll put these triangles as the trend keeps moving up and creates new lows or new highs. I'll put them up. And again, I'm targeting that midline. Interesting here, the target here, and it's a 2-to-1 target. So the height of the triangle is roughly $100, and then the distance here is $200. So that's just my convention, a 2-to-1 risk to reward, and that's definitely was targeted today, and it hit perfectly.
Wow.
Does that make sense? Kind of my battle plan?
It does. And yes, and hopefully it makes sense to everybody else. If not, reverse this whole talk, go back to where you began,
right.
Listen to it again. Because it does make sense. And I think it's important that I want people to understand that what you're really doing with this spread is you're putting on not a risk less trade, but you're putting on a very manageable trade in terms of risk, because it's a spread. Mm-hmm. But understanding then the mechanics of putting the trade on, managing the trade, and where you're going to put your stop, how you put your stop in. But these are all things that, should somebody have a solid interest, they would then get in contact with you, and you would help them with installation. And this is how you put your orders in. This is how you do the different things. Or you might just take a moment now and
why don't I do that? Let's do that. I'll show you how the so this isn't just an indicator, by the way. This is a entry management system, because Chart Trader and NinjaTrader is only good for trading one instrument at a time. So we needed a better approach, and that's where I have the interface up here, these buttons. And basically, buy, sell is the same as what you might see in Chart Trader, but it's gonna buy the spread or sell the spread. So buying and selling a spread involves two instruments. Again, buy one, sell another. So buying the spread means you're long on this proposition. So when you're saying that, you're going to be buying the long leg of the spread and selling the short leg. So it's a two operation process. When you're selling the spread, now that's reversed. Okay, you're selling the long, quote unquote, long part of the spread, and you're buying the short side of the spread, and that's the proposition that it goes down here. And that's I think it's pretty easy to relate that if you think of it long and short. Just think of this spread as its own derivative, as its own instrument, and you're buying or selling it. Yeah, but keep in mind, you will be, there'll be two commissions here. You're doing two instruments. You're buying one and selling one. So
your commissions are basically going to be double.
Yeah. Mm-hmm.
Or even a little bit more, because if it's 1-to-1, then it'll be double. But if it's balanced in terms of, like, sometimes when we're doing an equity using the NASDAQ and the S&P, they're going to be balanced out in terms, because it's money.
Right.
It's the value of the contracts against each other.
Let's do one quick here that kind of talks about that, Michael. This is now, I just have a chart of the mini NASDAQ against the mini Russell. But since the NASDAQ is such a big mover in dollar value compared to the Russell, and that's what my V-dollar ratio shows, it shows the volatility in dollars on a daily basis. So in order to kind of equate these two instruments, you need to trade more of the Russell to equate to one of the Russell NASDAQ. Mm-hmm. So my V dollar ratio here shows that 1 mini NASDAQ versus 2.6. I give a 1 decimal place on the Russell. So since you can't obviously trade, partials of the contract, you round it either up or down, and I rounded it up. So this is 1 mini NASDAQ against 3 mini Russells. So this is an unbalanced spread in an attempt to equate the dollar movement of these two instruments. And that's what this is. So when we buy this one, we're trading 4 contracts, 1 mini NASDAQ against 3 Russells.
Mhm.
So something to keep in mind. Now this will be a four commission charge, but so the indexes, same thing. We see a deeply oversold area down here. Obviously, we saw it oversold at the open here at 9:30. We're looking to trade back toward the midline, and we hit it perfectly.
Twice.
Yeah, twice. Now this spread value history, this history line, the dots here, the green and the red dots, it meandered a little bit. It wasn't to me as convincing as being down the whole day. It comes back up. You can see in the future we're predicting it to return at about 4:15 in the afternoon. So it's meandering. So I wouldn't call this a strong bias. So therefore, I'm looking to buy at the lows of the move or sell at the highs because it averages about the middle line.
Right,
Yeah.
right. And there've been a couple of opportunities, and another one might be coming up very shortly.
Yeah.
Because I trade the NASDAQ, and most people know.
Mhm.
So I just think it's like, but it has been kind of wild and woolly. So
It's a big morning today. Yeah.
it has been, and not always as easy to trade. So one of the things that I want to include when we're just attempting to trade the NASDAQ all by itself, there are going to be factors that are jamming the NASDAQ in one direction and the Russell in the other direction. Particularly today, when the opening, we saw kind of everything sold, but then it switched and they turned right back to buyers. But understanding where that buying was coming from. The selling initially was in Tesla. So
Yeah.
again, what I like about doing the spreads, you don't have to go and worry about the weighting of a stock like Tesla and Apple within the NASDAQ, also within the Russell, right? But the weighting may not be equal. So the moves are going to come out more intensely in the NASDAQ than they will in the Russell. So using this spread in those volatile moments, again, as long as you're following your chart, which told you pretty much right after the opening, buy it.
Right.
And then it went up, but it came back down, but it told you to buy it again.
Right.
And so it's a matter of following your signals, following the market, but you've just now taken out so much risk in entering a trade in the NASDAQ by itself.
Right.
Which can tend to just get squirrely and wild and crazy and make you crazy because you're like, well, I bought it and you guys decided to dump it. And so instead of making $200, you're now down 400.
Yeah.
And within the next 2 minutes, you're going to be back up 800. And that's the craziness of the NASDAQ. And it's simply being balanced out with all of the different players that come in with their opening orders, with their market orders and how things are trading. And then we add to that, what's trading within the options of Tesla? What's trading in the options of Apple? How are they now going to figure all this in, et cetera, et cetera. And what I like about removing all of that is how the spread and the mechanics of the spread and the weighting that you're putting on between 1 versus 3 remove so much of that concern.
Right.
Now you
That's
can
the goal.
just trade. You can just trade and take advantage of those moves because you've made a little combination which takes all of those extremes and does that, kind of caps them off.
That's right. We try to cap them off by doing correlation again. We look at the move.
I think this is an important factor because so many of people that are coming to me, they're coming to you, they don't have a $5 million account where they can go play with the big boys. We're all
Right.
starting with 50,000 or 100,000 or maybe even less. So the importance of managing risk from the get-go is extremely important, which is another reason why I really like the whole concept of this product,
Mm.
because we're managing the risk that we take every time we hit a buy or sell.
Right. That's exactly
And
right.
and when you can manage the risk, the next thing that kind of starts to disappear is the fear. You're not chasing trades. You're not worried, oh my God, am I going to get crushed? Because number one, you basically have put in a nice hedge of two indexes that really do move together. Yes, there are times when one will be going up and the other will be going down, and that's the beauty of the spread. So
Exactly
we're
right.
capturing everything together. And that's why I'm just so happy to present this product
Great.
and to have you along for the ride while we do
Well,
it. Tell us about
I
it.
think it could be a game changer in that way because
I agree.
it's a professional approach to the markets. Guys out there, I think moving big money are not just going long 1,000 contracts at the Nasdaq. They know their risk. They're hedging them.
And if they're not, they're really gambling.
Yeah.
But you're right. And we can't know, for example, that someone's deciding they're going, like last week, end of the year, what we saw was this humongous institutional changing of hands in Tesla, where it started like at the 104 level, right? It got down to 104 and they said, oh, that was enough. We're all now turning into buyers. So here came those that needed to buy back in, or just that they were buying in because of the level. Run it all the way back up to 123s where it expired on Friday. So again, all those options expire. All these positions now have settled. And what's it look like coming into Monday morning or Tuesday morning, right? Because we had a holiday yesterday. It was like, oh my God, I'm too long. I don't want this much stock. I don't want this position. And they start selling Tesla. Now, how do we kind of combine that and go like, well, what I can do against this? Well, to realize that Tesla is in several of the indexes, NASDAQ, of course, being the biggest, but it's in the S&P and it's in the Russell. The only one it's not in is the Dow. So you can combine these futures with BOSA and participate in what's happening in Tesla or Apple or Microsoft. As these things rotate around, it all gets reflected out in the price action. And using this product, folks, is really no matter if you're using it in, like I see down on the bottom, you've got wheat and soybeans. I see you've got I don't know what LE is.
That's live cattle and corn.
Okay.
Little odd, yes.
Well, no, it's not. It just makes total sense. If you
Right.
are in agriculturals and you understand live cattle got to eat something in the winter.
That's right. Yes.
And it's corn. And then we have wheat and soybeans, which are very correlated. We have NASDAQ against the Russell. We've got the two crudes that we talked about. And now we have adding to that, which I love. So you can get a really rounded portfolio just if you want to trade it accordingly, because you can do currency futures. And you don't have to be an expert about all of the crosses and what they're moving around. You just kind of got to follow what your histogram, what your indicators that Ben has included in this product, what they are telling you, and then go and put your trades on, and you manage your risk. So, folks, I really do think that this is a product that needs strong consideration to be added to your arsenal of trading products. Now, as Ben has told me, and I'm sure he's going to add it again here, this isn't something where you just kind of put it on and walk away. It will require your attention because, again, Many crazy things can happen in a market between the hours of 9:30 and 4 o'clock Eastern. Many things, jumps, bumps, grinds, crazy.
Right.
And so you don't want to just leave something all by itself. But then I know you and I have talked about it, but you have the ability, and if you could just show us quickly, we get into a trade, where do I put that stop? How do I put that stop? How can I move that stop? How can I put all this together and then use that management, which is going to be me, to actually physically put it in and get it out?
Right. Yeah. Good point. Yeah. Let's do that. Let's show there's the order management system, I think, is one of the great features of this indicator. And since we don't use everything is going in at market, we don't limit in on anything because you want to get filled on both instruments simultaneously. So there will be some slippage there, but keep that in mind. I'm going to turn on the AT lines. These are AT lines. Now, there's two versions of BOSA. There's a basic version that doesn't have this nice interface, and then there's the full-blown BOSA AT. And these are trade lines. So these are levels at which I'm interested at buying or selling at. So these are just horizontally drawn lines, horizontal lines, and the indicator draws them for us when we click on the remove AT lines or show AT lines. This line, it will be a sell level. We don't want that one up here yet. Let's say we were looking at buying when we hit this this low. The blue line is a buy line. So I would have put the buy line right above the high of this move right here. And let's see, let's make sure that we've got that showing up as a buy. So that would have been an area that we were buyers. And it's a touch system. So the minute that we have the market touches that blue level, it will buy the spread. And you can actually now also add additional AT lines just by drawing a horizontal line. Oops, I didn't hit the right one. F6, I believe. Okay, let's say we wanted to, there we go. We wanted to make this a sell level in BOSA. And all we need to do is edit the line. And I don't know if you know, if you double click on a drawn object in Ninja, it brings up drawing objects. And you go into here, and we want to make this a sell level. All we do is change the tag to sell and hit OK. And this now becomes a sell level in BOSA. So it would have been a stop loss, let's say. We would have bought here and we would have sold here. And that's really the simplest approach to using the interface. We would be buying 1 or 2 contracts. We can use our mouse wheel here to increase the number of contracts we're buying or selling. And number of spreads.
Pay attention to that, folks. If you have this system, please pay attention to what you're clicking on.
Yes. So you can use your mouse wheel to increase the number of spreads you're trading. So 3 spreads here would be 3 times 4, would be 12 contracts total. But you're long 3 spreads, and the grid value changes when you increase. So now each grid is $150 because you're trading 3. So it automatically updates that. If I go down to 2, now the grid is at $100. And really, that's it. So now we would have gone long at the blue level. Use this as a stop. To trail a stop is really just a matter of moving it up manually, and we can do that with the mouse.
Important stuff to really understand.
Yeah, and if you join up, we'll definitely go through all of it, and we'll have a sit down together, and we can go through that.
I know. And I have to tell you, folks, it's like the sit downs are really important, and do not be afraid to say, Ben, slow down.
Yes.
Because when you're talking to the person who's done all the coding, this is second nature to Ben, and it may not be second nature to each one of us.
Good point.
But again, the value that I'm trying to put together here for all of us is the uniqueness of the product, the value of the product, in adding it to our arsenals for trading. And particularly as we're moving through an extremely volatile period, not as it's measured by the VIX, folks, because the VIX volatility is based on options, not necessarily based on how fast these indexes are going from point A to point B and back again. So we need to pay attention to what I mean by volatility. And it's usually, I equate it to like the velocity, the speed at which the market is moving, and how quickly and how quick they'll change their minds. And it isn't even necessarily that someone is changing their minds. It's how the orders are being stacked. Now let's add into that, particularly if you're trading in an index, an equity index market. You've got options listed on, I don't know any of the stocks within the NASDAQ or the S&P, the components that don't have options listed on them. So much is like, well, the market's bullish. It's like, no, the market just is really trading against what the options are doing. And so again, if I'm selling a bunch of puts, because that's where the premium is, well, the hedge to that is selling the underlying. What happens then? So the index is going to go. It's going to follow along with. And conversely, if I'm buying a bunch of calls, I still want to hedge it by selling the underlying. Now, whether that underlying is the SPX, the ES, the NQ, the NDA, or excuse me, the Russell, or is it the IWM? Is it the Qs? Now let me just go down my list of instruments. We have the NASDAQ future, we have the Qs, which is the index or the ETF. Then we have the ultra long, the TQs, we have the ultra short, the SQs, and each one of those has options that trade like May wheat, as they say in the old days. So we have so many factors and so many things that are going to facilitate a trade. I like having the ability where I can stick to some well-designed indicators that tell me, A, let's look at the history of what the prices do. B, let's look at where these extremes are. And that's where I want to get in and get out. Because again, the yellow line that you've so aptly shown us, that's the midpoint.
Right. Equilibrium level.
Markets just tend to go to one extreme, back to the midpoint, other extreme, back to the midpoint, et cetera, all day long, until that midpoint actually begins to shift. That's directional trading then. But right now, we're kind of like sitting in between. So we're still like, we're up and down, even though the markets technically have continued just to move lower. But in terms of blending these, they're hugging around their midpoint.
Right. Like, look at this market here right now, Michael. We're looking at the future spread history shows from this red dot straight up until about the 1530, about 3:30 time. We're starting to see some buy cycle dots coming in. The trend is still down, but I'd be interested in perhaps going long on a break upward here. So,
right, because we're preparing ourselves for the next couple of hours.
Yeah, the phase here after the 1:15 time, we seem to move into 3:30. This has been up. Now, this what it means is that the NASDAQ outperforms the Russell. When this spread moves up, it means that the NASDAQ is moving up faster than the Russell. Or
surprise.
Or that the Russell typically moves down faster than the NASDAQ does. So on a downward day, the Russell tends to tank more. On an upward day, the NASDAQ seems to rise faster. So either way, either one of those two situations happen, and this spread does rise. Again, because you're long on the NASDAQ. If you buy this spread, you're long on the NASDAQ, you're short on the Russell.
And I would kind of agree with that. And I know that we're heading towards that. Could be, it's all interesting, but yes, it's all interesting.
Yeah.
And
really, this just shows the data mining. We do show that statistically, this is what happens over the last, I think I've got 15 days of data. So this is showing us, we see a bottom in this market. It moves up till about 3:30. So something to think about. Give you a little forewarning.
Right. And I think many of us as day traders, or even in position traders or swing traders, this is a great add to how and what you want to trade. I do get a lot of people that come to me and we're talking about just the craziness. How do you want to do this? Or particularly because I go and update an Elliott wave every day. What's the market doing? What's it going to do? And et cetera, et cetera. Well, I want to tell you the last week and a half, I was like, roll the dice, folks, because that's basically what the market's telling me. They have no idea.
Right.
And so I would say one thing, you come in the next day doing the opposite. And so, but finally, because it is the market itself, folks, it's not me, it's not Ben, it's not even our indicators. They're indicating. And this one's a little bit of leading versus being lagging, because it's taking history, calculating it, and showing us historically over the last 15 days, the NASDAQ has rallied to starting now and going until 3:30. So all good stuff. And I think this is what adds to the value of putting this into your trading tools. Again, I'm just going to say, because I'm going to start to put us into that downward until we're concluding ourselves for today. First thing I want to ask is to make sure that you tell us your link or the name of your YouTube channel so that folks can go in, because Ben does put lots of videos on YouTube. They're quick, but you can go in, you can see how this is, how it works, what it goes, how it does. And there you go. Money range 7.
Money range 7.
Folks, check it out. There are a lot of videos there. You can see how this all works. And next thing I want to make sure that I include, Ben, let us know how people can get a hold of you, because they may have questions or they may have an interest in seeing about getting this for themselves.
Yeah.
And so I want to make sure that they can do that. And folks, this will all be also included within, once I get this posted, it'll be within the notes. So all of these things will be within the notes itself, and you'll be able to pull it from there as well.
Right.
So Ben, wrap it all up for us.
Yeah. So I put in these 2 links here for you. Here's my email address. You can contact me there anytime. And then, of course, my leave comments or questions in my videos. Go to the YouTube channel and definitely be looking for your comments and questions there. Like and subscribe. I appreciate it. And if you are interested in buying, I do have a special going on right now, since it's a launch here. Here's the website you want to visit. It's bosa.carrd.co. So keep in mind on that one. It's kind of a unique URL. Give a little write-up here of what's going on with the indicator, kind of a summary of the theory of spread trading, which you might find interesting. Right here, we write about that. Here's a summary of what you get when you buy BOSA. I do have one of my videos here talking about how I consider this to be the stop-loss solution, trading correlated markets and using them to your benefit. I do want you to read this. Who should not buy BOSA? BOSA is not for everybody, okay? It's not for new or inexperienced traders, because you are trading 2 contracts and you need to be wary of what's going on. So there is some cautionary tales here. You know, we're here to trade elite, make you to be an elite trader, and use professional tools. So feel free to read through that. Now here is our purchase page. Again, I mentioned there's a basic, BOSA basic, and there's also BOSA AT, which is assisted trade, which is what I was demonstrating today. BOSA AT is selling for $49.95 and a one-time purchase. But because of the launch today and working with Michael, we are selling the AT version right now for the $849 price yearly. So you can get the entire set of suite that I've given you, all the AT system. We can set you up. We can, get you installed and do one-on-ones with you. All that is included for just the $849 price. So buying through that link right here will get you actually the AT version again during this launch period.
And I want to add, because I see the PayPal button.
Right.
if you're looking at this going like, holy cow, that's so expensive. See that PayPal button a little further down, says pay later. That one's important, folks, because PayPal has given us the ability where we can have payments.
Right.
So
Right.
they front it all out for you, just like it's like having a credit card, except now your credit is PayPal, and it's
Right.
PayPal credit. So, but it's very useful, and often they will have 6 months interest free. So you purchase something, and if you can arrange to pay that off within 6 months, you don't get charged any interest.
Right.
Beyond that, if you go beyond that 6 month and you still have that debt, then the interest will get added to your account.
Right.
So,
And I think that's only for American customers, but you'll know if you have the
you're right.
yeah,
You're right on that.
I think it's only for America right now.
But since we're dealing in dollars, folks,
Right.
it's like you're going to have to convert anyway and come on over and deal in dollars with us. And maybe if you have a dollar account and you can get that together with PayPal, maybe they'll give you the deal. I don't know.
Right. But if you do purchase, again, for the deal today, you do want to use the button on the left side, and I think there is a pay later option on that button. But you'll just make sure to use the button on the left under the 849 yearly, and you'll buy it, but you will be sent, and we'll work with you on getting it installed, the AT version. Make sense?
It does. Tell us once again, if they wanted to buy the AT, but they want to take advantage of this
Right.
extremely attractive price.
Right.
How are we doing it?
Yeah, so you'll get the AT version when you purchase from the left side link. And anyone who purchases on that left side link right under the basic column here, you will be sent the AT version. And
Okay.
yeah, so it'll be $849 yearly again. So every 12 months there will be a purchase. So your license will last for the full year. And if you decide to continue, again, that's fine. If not, your license will expire. So it's very simple.
And folks, I'm telling you right now, I'm going to get we're setting this up on my computer. I've had it, but I've had a few kinks just in my own self on getting it. So if I can get it together, I will be trading with this in my trade room.
Wonderful.
And send me an email, folks, or comment on my side, and I will get you the information for the trade room. And you buy it, I have it, we'll be trading it together, and that will even be better. And who knows, you might even get guest appearances by the author.
Bring me in. I'd love to visit.
So
again, that website right up here is bosa.carrd.co. I think you can see it there.
I can. I've written it down.
All right, great. And we'll put that in the show notes, I'm sure.
Yes, I will. And Ben, I want to thank you. I'm afraid that we're probably going to have to do a part 2 on this, because I think there's still more to actually talk about and break down and show people, and we may do that. But I think what was important for today is that I wanted to introduce my friend Ben to my side of the market and get this interest, because folks, I'm not blowing smoke. I think this is a great product, and it truly does work, and it does remove a lot of the anxiety, the worry, the doubting, the fear of missing out. Everything kind of gets taken away, because it's a different style and a different type of trading. We call it hedging.
Right.
So your clearing firm is going to love it. You're going to love it. Does that mean that you can't lose money? No. You can. You have to pay attention. So you still have to use your rules. But again, you're working with Ben or you work with me. We're going to tell you the same thing.
Yep.
Oh yeah. Thank you so much,
Michael. What a pleasure, man. Thank you for that. The whole time I've just enjoyed it. I'm excited about bringing this product to market, and we're going to make some breakthroughs for people.
Yes.
I
agree. I definitely agree.
Wonderful. Bring me back, because I want to visit again with you. It's been a pleasure.
That I shall do.
All right.
First thing I want to do is I need to go back over here. I need to reclaim the host. So now I'm back over here. It's just me and you showing.
Okay.
And again, thank you so much. And we will definitely be in touch, because I know I need some refreshing, because I told you I've switched my computers around.
Yeah, so we'll get that straightened out.
And people, please take down those addresses. Get in contact with Ben. Ask the questions you need. Get in contact with me. I'm always great at forwarding things.
Yep.
Have a great afternoon.
Thanks, guys. Bye-bye.
Bye. I'm market analyst Michael Filighera of Traders Helping Traders, helping you make informed trading decisions for the week ahead.